Welcome to the Business with Beers podcast. This is the place where we help entrepreneurs turn their business income into passive income. I'm your host, Brian Beers, an entrepreneur on a mission to inspire growth from everyone around me. I'm going to show you how to create generational wealth by growing your business and breaking the chains of Wall Street investing. Remember, you need to take the actions that others won't to live the life that others don't. This is the first episode in a new series I plan on launching every Thursday. It is a short solo episode in which I highlight some gold nuggets from a recent guest, talk about how I'm going to apply that advice in my own life, and provide some updates on my personal business and investing journey. This week, I had Holly Williams on the show. Holly is a former marketing executive turned full-time real estate syndicator. I was introduced to Holly by our mutual business coach, Trevor McGregor. I actually invested into one of her apartment syndication opportunities a couple months ago. And in this episode with Holly, we touch on a lot of different topics, including the truth about retirement, passive income, and syndications. Holly had this great quote about retirement. She said, "The first thing a financial advisor asks you when you sit down with them is, how long do you expect to be retired?" And as if our whole system is designed for us to die broke. Thanks to the government, we are taught that retirement is an age. It's 67 years old. And once the calendar turns, you can move to Florida, play shuffleboard, and eat dinner at 3 p.m. We are taught that saving for retirement is like charging a battery your whole life. And then when we turn 67, we deplete that battery until we die. But retirement is not a date. It's a mindset. It's a lifestyle. The definition of retirement is freedom. Having the freedom to live where you want to live, spend time doing the things you want to do, and with people that you love. And in order to live that lifestyle, you need passive income to exceed your living expenses. And the majority of Americans are taught to rely on Social Security for the passive income, hence 67 as the date. But I don't know about you, but I don't want to stake my entire family's financial future on trusting the government. For all we know, that Social Security could be gone in a couple decades. But you can achieve the lifestyle much earlier than 67 if you focus on creating multiple streams of resilient passive income. Holly has another great quote. She said, "The wealthy think about money differently. They think about keeping it in motion. They think about investing in cash flow assets. They think about generational wealth." I've been fortunate enough to spend time with some very successful and wealthy people, and she is 100% on point here. Wealth is created through the power of compounding, which means putting your money to work to create more cash flow. Then you put that new cash flow back to work to create more cash flow, and so on. The wealthy actually want to be, quote, cash poor. This means they have very little cash in the bank, and they want almost all of their capital deployed into assets that produce more cash. They understand that cash in the bank, especially these days, is losing value to inflation. And the only way to keep up with inflation is to invest as much as possible into assets that also rise in value thanks to inflation. So how do we go about creating resilient streams of income? I can tell you the stock market is not the answer. It's going to have big swings up and big swings down. A single tweet could send a stock crashing. A change in the government leadership can have a drastic effect on the value of your portfolio. You have absolutely no control. We are taught that if you want steady income, to put our money into bonds that pay a pathetic return of 2%. And while our money is technically growing, it's actually losing buying power because inflation is growing much faster. One of the best ways to create resilient streams of income is through real estate investing. And there's a lot of different ways you can invest in real estate. And what we're going to talk about is private real estate investing through what are called syndications. This is the path that Holly went down. A syndication is a group of investors who pool together experience, time, and money to acquire, operate, and ultimately sell a large real estate asset. The target property could be an apartment building, a self-storage facility, an office building, or any commercial property. Holly started as an investor into other people's multifamily syndication deals. The properties she invested in were profitable, and she started receiving checks every month in the mail while having zero involvement in the operation of these apartments. And after seeing the power of being an investor, she eventually quit her marketing job and went full-time into being a syndication operator, meaning she flipped the coin. She went from being an investor in a syndicator to being the operator or the general partner. Those terms are sometimes used interchangeable. So she then created a team, and they went out to acquire properties. They raised capital from other investors, from people just like herself. and they manage the asset to execute the business plan. I personally love investing into real estate syndications as a limited partner right now. I am focused on growing multiple businesses, this podcast, and spending quality time with my family. I don't have a lot of time to go out and manage an apartment building or to find one or to raise a ton of money. So my plan is simple. I just find people like Holly. I partner with trusted, experienced operators who have a team of people who do all the work. If they bring a property that fits my criteria, then I'll write a check and I'm done. The property starts cash flowing, distributions start showing up in my bank account. I've created this new passive income stream. There's also times where great operators like Holly will bring a deal and it just doesn't fit my criteria, right? It's different from what I want to see and the returns I want to get. So as of today, on the real estate side, I'm invested in a couple of deals. I got Holly's apartment building. I've got 2 self-storage facilities. There's 2 self-storage deals that cover 6 to 8 different facilities. That's a portfolio. I have a hotel and a wedding resort and a new construction office building. Each one of these should provide an annualized return of somewhere between 15 to 20% on my money. But the thing about syndications and most private investing is the returns aren't linear. I'm not going to get 20% per year. But my bread and butter stabilized apartment deals like Holly's, I expect to see a cash on cash return of somewhere around 7 to 10%, and get paid monthly. And then when the property is sold or it's refinanced, there's the big payday, and that's when you return all the capital you put into it plus a percentage of the profits. Now you do the math on what you got in total return over the number of years. That's how you get the average annualized return. And we compare that to the stock market. The stock market over the last 20 or 30 years historically produces about 10% annualized per year. And so the deals I'm investing in, 15 to 20, we're talking about potentially doubling the returns. And when you compound doubling the returns over a number of years, I mean, the results are astronomical. So, I've also invested into some other large construction deals that require a bunch of their capital up front. And in those, they're building from scratch, they're doing renovations or significant add-ons. These assets have minimal or zero cash flow in the beginning, since most of that capital is used up for construction. And there's definitely increased risk with this type, but the payoff is much greater. The more value you can create, the more money you can earn, and tremendous value can be created through construction. In these deals, I expect to earn 25 to 30% kind of annualized return on those deals. But if you're just starting out investing in syndications, I'd probably go with a stabilized asset like something that Holly would offer. There's a number of great other operators out there. Anyway, start thinking about retirement as a lifestyle that you can create, not a date. And I've got a homework assignment for you. Figure out how much passive income you would need to retire. Take up all your living expenses, add another 20% or so for savings. So if you've got $5,000 a month in living expenses, you would need to generate $6,000 per month in passive income to have that ability to retire, if you choose to. And then start tracking it. How many passive income streams do you have, and for how much? I'd set a goal then to incrementally increase your income streams. For example, if you have a goal of adding $1,000 per month of passive income per year. So if you're currently at zero, like the only money you get is from your job or your business, you have no other passive income streams. The goal is within 12 months from now, you would then be generating $1,000 per month of passive income. Then in another 12 months, you generate another $1,000 during that period. Right now you're at $2,000 per month, and so on. And at that rate, assuming your expenses don't drastically increase, within 6 years, you should have $6,000 per month. And if you choose to retire at that point, you could, or you could potentially quit your job, sell your business, right? Focus full time on creating more streams of passive income. The idea is you've got flexibility. Passive income creates flexibility to do what you want to do. That's all we got for this episode of the Business with Beers podcast. One thing that would really help both us and new potential listeners is for you to rate this show and leave a comment in iTunes, Stitcher, or wherever you listen. Also, make sure to link up with me on your preferred social media platform, LinkedIn, Instagram, Twitter, Facebook. You can find all of my links, brianbeers.com. Please just share this podcast with anyone who you think might enjoy it. And until next time, remember, take the actions others won't to live the life that others don't. Cheers.